Welcome! Today, we're diving into the world of diversification, a fundamental principle in investing that helps manage risk. While diversification is often praised as a way to protect your portfolio, it's not foolproof. Many investors fall into common traps, thinking they're diversified when, in reality, their portfolios are still exposed to unnecessary risks. In this video, we'll explore the most frequent mistakes people make with diversification and how you can avoid them to build a stronger, more resilient investment strategy. Let's start by understanding what diversification truly means and why it matters for every investor. Diversification is the practice of spreading your investments across different assets, industries, or geographic regions to reduce risk. The idea is simple. Don't put all your eggs in one basket. By holding a mix of investments, you're less likely to suffer significant losses if one area of the market underperforms. However, true diversification goes beyond just owning a handful of different stocks. It requires thoughtful selection and balance to ensure your portfolio isn't overly dependent on any single factor. Let's look at why this concept is so important for long-term financial health. One of the most common mistakes is overconcentration, putting too much money into a single stock, sector, or asset class. Even if you own several stocks, if they all belong to the same industry, your portfolio is still at risk if that sector faces trouble. For example, investing heavily in technology stocks may seem diversified, but a downturn in tech can impact your entire portfolio. To avoid this, ensure your investments are spread across different sectors and asset types, such as stocks, bonds, and real estate. Another pitfall is false diversification. This happens when investors believe they're diversified simply because they own many different stocks or funds. However, if these investments are highly correlated, meaning they tend to move in the same direction, your risk isn't truly reduced. For instance, owning several large-cap US tech companies may look diversified on paper, but they often react similarly to market events. True diversification requires mixing assets that behave differently under various market conditions. Asset allocation is the process of deciding how to distribute your investments among different asset categories, such as stocks, bonds, and cash. Ignoring asset allocation is a major mistake. Even if you own many stocks, without balancing them with other asset types, your portfolio may be too risky or too conservative. The right allocation depends on your financial goals, risk tolerance, and investment timeline. Regularly review and adjust your allocation to stay aligned with your objectives. Many investors focus solely on their home country's markets, missing out on the benefits of international diversification. Different countries' economies and markets don't always move in sync. By including international stocks or funds in your portfolio, you can reduce risk and potentially enhance returns. However, be mindful of currency risks and political factors that can affect foreign investments. The key is to find a balance that fits your risk profile and investment goals. While diversification is important, over-diversification can also be a problem. This occurs when you own too many investments, making it difficult to manage your portfolio effectively. Over-diversification can dilute your returns and increase transaction costs. Instead of spreading yourself too thin, focus on a well-chosen mix of assets that provide true diversification without unnecessary complexity. Quality matters more than quantity when it comes to building a strong portfolio. It's tempting to chase after the latest hot sector or asset class, but this can undermine your diversification strategy. Jumping into investments just because they've recently performed well often leads to buying high and selling low. Instead, stick to your long-term plan and maintain a balanced portfolio. Remember, past performance doesn't guarantee future results. Diversification is about steady growth and risk management, not quick wins. Over time, your portfolio's asset allocation can drift. As some investments grow faster than others, ignoring rebalancing can leave you with unintended risks. Regularly reviewing and adjusting your portfolio ensures you maintain your desired level of diversification. Rebalancing might involve selling some assets and buying others to restore your target allocation. This disciplined approach helps you stay on track and manage risk effectively. Diversifying across many assets can increase transaction fees, management costs, and taxes. These expenses can eat into your returns over time. It's important to consider the cost of each investment and look for low-cost options, such as index funds or ETFs. By keeping costs in check, you can maximize the benefits of diversification without sacrificing your long-term growth. Taxes can have a significant impact on your investment returns, especially when you frequently buy and sell assets. Some investors overlook the tax consequences of diversification strategies, such as capital gains taxes or the impact of holding certain assets in taxable accounts. To optimize your after-tax returns, consider tax-efficient investment vehicles and strategies, and consult with a tax professional if needed. Correlation measures how assets move in relation to each other. A common mistake is assuming that owning different stocks automatically reduces risk. However, if those stocks are highly correlated, they may all decline together during market downturns. To achieve true diversification, include assets with low or negative correlations, such as bonds or alternative investments, alongside stocks. Investors sometimes buy multiple mutual funds or ETFs, believing this increases diversification. However, many funds may hold similar underlying assets, leading to overlap. This reduces the effectiveness of diversification and can increase risk. Before investing, review fund holdings to ensure you're not duplicating exposure to the same stocks or sectors. Alternative assets, such as real estate, commodities, or private equity, can provide additional diversification benefits. Many investors overlook these options, focusing only on stocks and bonds. Including alternatives in your portfolio can help reduce overall volatility and improve risk-adjusted returns. However, be sure to understand the risks and liquidity constraints associated with these investments. Emotions can cloud judgment and lead to poor diversification decisions. Fear and greed often drive investors to make impulsive changes to their portfolios, such as selling during downturns or overinvesting in trending assets. Staying disciplined and sticking to your diversification plan is crucial for long-term success. Avoid making investment decisions based on short-term emotions. Liquidity refers to how easily you can convert an asset into cash without affecting its price. Some investors overlook liquidity when diversifying, investing heavily in assets that are difficult to sell quickly, such as real estate or private equity. It's important to maintain a balance between liquid and illiquid assets to ensure you can access funds when needed, especially in emergencies. Your investment time horizon, the length of time you plan to invest, should influence your diversification strategy. Younger investors with longer horizons can typically take on more risk, while those nearing retirement may need a more conservative approach. Ignoring your time horizon can lead to mismatched investments and unnecessary risk. Always align your portfolio with your financial timeline. Every investor has a unique risk tolerance based on their financial situation, goals, and personality. Failing to consider your own comfort with risk can lead to poor diversification choices. If your portfolio is too aggressive, you may panic during market downturns. If it's too conservative, you might miss out on growth. Assess your risk tolerance honestly and build a portfolio that matches your needs. Markets and personal circumstances change over time. If you set your portfolio and forget about it, you may miss opportunities to improve diversification or adjust to new risks. Regular portfolio reviews help you stay aligned with your goals and adapt to changing conditions. Schedule periodic check-ins to assess your asset mix and make necessary adjustments. Market cycles, periods of growth, and decline affect different assets in various ways. Some investors fail to adjust their diversification strategy as market conditions change. For example, holding too many growth stocks during a downturn can increase losses. Understanding how different assets perform in various cycles helps you maintain effective diversification and manage risk throughout economic ups and downs. It's easy to assume that assets or funds that performed well in the past will continue to do so. However, markets are unpredictable, and past performance is not a reliable indicator of future results. Building a diversified portfolio based solely on historical returns can lead to disappointment. Instead, focus on fundamentals, risk management, and a balanced approach to diversification. Inflation erodes the purchasing power of your money over time. Some investors focus too much on low-risk assets like cash or bonds, which may not keep up with inflation. To protect your portfolio, include assets with growth potential, such as stocks or real estate, as part of your diversification strategy. Balancing risk and return is key to preserving and growing your wealth. When investing internationally, currency fluctuations can affect your returns. Ignoring currency risk can lead to unexpected losses or gains. Some investors hedge currency exposure, while others accept the risk as part of diversification. Understand how currency movements impact your portfolio and decide on a strategy that fits your risk tolerance and goals. Large, established companies often dominate investors' portfolios, but small-cap stocks and emerging markets can offer diversification, benefits, and growth potential. These assets may be more volatile, but they often perform differently from large-cap stocks, helping to balance your portfolio. Consider including a mix of company sizes and geographic regions for broader diversification. Diversification involves using various investment products, such as mutual funds, ETFs, and individual securities. Not fully understanding how these products work can lead to unintended risks. For example, some funds may use leverage or derivatives, increasing volatility. Always research investment products thoroughly before adding them to your portfolio. Behavioral biases, such as overconfidence or herd mentality, can influence diversification decisions. For example, following the crowd into popular investments may lead to overexposure in certain areas. Being aware of your own biases helps you make more rational, objective choices and maintain a well-diversified portfolio. Sector rotation is the practice of shifting investments among different sectors as economic conditions change. Ignoring sector rotation can leave your portfolio exposed to underperforming areas. By periodically reviewing sector allocations and making adjustments, you can enhance diversification and capture opportunities in various parts of the market. Tax-advantaged accounts, such as IRAs or 401ks, can help you grow your investments more efficiently. Failing to use these accounts as part of your diversification strategy may result in higher taxes and lower net returns. Consider how different account types fit into your overall plan and use them to maximize your after-tax wealth. Some investors try to manage diversification on their own without seeking professional advice. While self-education is valuable, financial advisors can provide personalized guidance and help you avoid common mistakes. Don't hesitate to consult with a professional, especially if your portfolio is complex or your financial situation changes. Reinvesting dividends and interest can enhance your portfolio's growth and improve diversification over time. Some investors spend these earnings instead of reinvesting, missing out on compounding benefits. Make a habit of reinvesting income to maximize returns and maintain a balanced asset mix. Diversification should be guided by your specific financial goals, such as retirement, buying a home, or funding education. Without clear objectives, it's difficult to choose the right mix of assets. Define your goals, timeframes, and risk tolerance to create a tailored diversification strategy that supports your long-term plans. Economic and political events can impact markets and asset classes differently. Ignoring these risks when diversifying can leave your portfolio vulnerable to shocks. Stay informed about global trends and consider how changes in interest rates, regulations, or geopolitical events might affect your investments. Adjust your diversification strategy as needed to manage these risks. Major life events such as marriage, children, or career changes can affect your financial needs and risk tolerance. Failing to update your diversification strategy after these changes may result in a portfolio that no longer fits your situation. Review your investments regularly and adjust as your life evolves. Automatic investment plans, such as dollar cost averaging, help you invest consistently and reduce the impact of market volatility. Some investors neglect these tools, missing out on the benefits of disciplined investing. Setting up automatic contributions can help you build and maintain a diversified portfolio over time. Employer-sponsored retirement plans, like 401ks, often offer a range of investment options and tax benefits. Some investors overlook these opportunities when diversifying. Take advantage of employer matches and review plan options to ensure your retirement savings are well diversified and aligned with your goals. Socially responsible investing, SRI, allows you to align your portfolio with your values. Some investors avoid SRI, fearing it limits diversification. However, many SRI funds offer broad exposure across sectors and regions. If social or environmental factors are important to you, explore SRI options that still provide effective diversification. Inflation-protected securities, like TIPS, can help safeguard your portfolio against rising prices. Some investors ignore these options, relying solely on traditional bonds. Including inflation-protected assets as part of your diversification strategy can help preserve your purchasing power over time. The performance of actively managed funds can depend heavily on the fund manager's skill. If a manager leaves or changes strategy, it can affect your portfolio's risk and returns. Monitor fund manager changes and review your holdings to ensure they still fit your diversification plan. Succession planning ensures your investments are managed according to your wishes if you become unable to do so. Overlooking this step can create complications for your heirs and disrupt your diversification strategy. Establish clear instructions and update your estate plan regularly to protect your portfolio and your family's future. Insurance products, such as annuities or life insurance, can play a role in diversification by providing income and protecting against certain risks. Some investors ignore these options, missing out on potential benefits. Evaluate whether insurance products fit your overall strategy and risk profile. Currency diversification involves holding assets denominated in different currencies. This can help reduce risk if your home currency declines in value. Many investors overlook this aspect, focusing only on domestic assets. Consider adding foreign currency exposure to your portfolio for broader diversification. Environmental risks, such as climate change or natural disasters, can impact certain industries and regions more than others. Ignoring these risks when diversifying may leave your portfolio vulnerable. Assess the environmental exposure of your investments and consider how to mitigate potential impacts. Technology tools, such as portfolio trackers and robo-advisors, can help you monitor diversification and manage your investments efficiently. Some investors neglect these resources, missing out on valuable insights and automation. Leverage technology to stay organized and make informed decisions about your portfolio. Every investor makes mistakes, but failing to learn from them can be costly. Review your past decisions, identify what went wrong, and adjust your diversification strategy accordingly. Continuous learning and improvement are key to long-term investment success. In summary, diversification is a powerful tool for managing investment risk, but it's easy to fall into common traps. By avoiding these mistakes such as overconcentration, ignoring asset allocation, and neglecting regular reviews, you can build a more resilient and effective portfolio. Remember, successful diversification requires ongoing attention, discipline, and a willingness to adapt as your goals and circumstances change. Stay informed, stay balanced, and let diversification work for you on your path to financial security.